Yeah, hi, this is Mike Lembeck with Remax Commercial, bringing you today's Let's Talk About It specific news points that are pertinent to the real estate market and what's happening with the economy. Our first story is the home equity lines of credit were up 40% in the second quarter from a year earlier. So we're seeing a lot of homeowners using their current equity, this tappable equity that we've accumulated over the last few years with the high appreciation. They're using that to do several things to kind of keep themselves afloat with the inflation that's been ravaging everyone's bottom line, and also to do home improvements because they've got their current interest rates are very low at anywhere between 3 to 4%, sometimes even a little bit less than that, if they were to be able to take advantage of the low rates when they were at the lowest point. So instead of moving into a something like a larger home with more square footage, better location, they're staying put and using their equity to to do some home improvements and making do any maintenance that they would want to have done or that needs to be done from the portion of when they purchased the property that had something that didn't get completed as part of the sale, or like I say, home improvements, maybe an addition, a patio, pool, those types of things. So that's a lot of equity that's being tapped. So the clients are saying that they want a safety net as credit card bills rise along with unemployment fears. So those are other reasons why they're seeing these high HELOC loans. One of the most common uses for HELOC is a fund to fund home improvement projects. And then at the end of the third quarter, the average U.S. homeowner had $196,000 in tappable equity. That's down from 9.6% from the second quarter, but still up about 10% from the same time last year. And this is according to Black Knight data firm that does a lot of research on the real estate market and very accurate reporting. So there's quite a bit of home equity that's being tapped into, and again, it's a possibility that some of it is being used to just maintain their current status of living and pay their monthly bills. Our next story is here's why Home Depot and Lowe's are booming in a housing market bust. So Home Depot and Lowe's have seen an increase in sales over the last few months, and this is due to a lot of homeowners doing what's called improve in place. This is the mentality among current homeowners who might have wanted to sell but changed their mind because they could no longer command top dollar. So a lot of them again are using these HELOC loans, and they're going to Home Depot to purchase their products to do those home improvements. With rising mortgage rates, homeowners are staying in place. So there's no reason for someone to move if they've got the higher rates and the possibility of potentially losing that low interest rate on their current loan. Credit card debt jumps by the largest amount in 2 decades. The credit card balances increased $38 billion in the third quarter to $930 billion, the New York Fed found, with balances once again matching the pre-pandemic peak of $930 billion in the fourth quarter of 2019. Year over year, credit card debt grew by 15%. This is the largest jump in more than 20 years. So again, people who don't have home equity potentially are tapping into their credit card credit limits to again pay bills potentially, or a possibility of doing home improvements also. The delinquency levels increased by the most among I'm sorry, the delinquency levels increased the most among lower earners. So again, people who are tapped out, not making enough money to pay their monthly expenses, they're leaning on their credit cards to help pay that. In this chart here, we see the transition into delinquency, which is 30 plus days past due by loan type. You can notice that all loan types except for student loans are the only ones that are down, but all others are up quite a bit just in the last quarter. of 2022. So we're seeing a huge increase in delinquencies there. So that's foretelling of potentially some further problems down the road. Okay, so hopefully you found some of this information on these articles helpful in navigating the real estate market and the current economy, and to know kind of what's expected to come up here in the next few months. So, again, if you ever are interested in having me do an analysis on your property to take a look at your equity position and what potentially we could do as far as increasing your rate of return, I'd be happy to take do an analysis on it. I just need your income and expense information, and of course the property location, bedrooms and baths, and individual rents, and we could do an analysis of that for you to see if there's a potential to get you into a different property, 1031 exchange, or the possibility of moving your equity into a Delaware statutory trust, which has some pretty significant increases in, or the percentage of return on investment is pretty strong, and doesn't, or allows you to not have to do any of the property management, and helps you get out of the property and also avoid the capital gains tax by completing it using the 1031 exchange parameters. So feel free to give me a call on any of that information. And if you're currently interested in buying a property, I'd love to find out what you're looking for and see what we can find on the market. Again, the Delaware Statutory Trust could potentially be a vehicle for you to purchase some property also, and even if you're not doing a 1031 exchange. So I look forward to hearing from you. And if you need anything as far as real estate, any real estate activities, I'd be love to help you. Thanks, and have a wonderful day.